Nice to have you with us on this Friday morning. It's a busy one with jobs reports on both sides of the border. We just talked about Canada's economy showing signs of weakness with job losses in the July data. In the U.S., there was job creation last month, but less than anticipated. Let's get some more perspective on the market reaction. Right now, we're looking at U.S. futures modestly higher. Kathryn Rooney Vera is Chief Market Strategist at StoneX Group. Great to see you as always, Kathryn. What's your general view on what the markets are keying into these days?
Well, the non-farm payroll report came out a little below expectations, but the wage growth exceeded expectations, and 4.4% is inconsistent with the 2% core PCE target. That should be closer to 3.5%. That's my estimate, and that's the 50-year historical average consistent with the 2% target. So I think the markets, what they're focusing in and why we've seen this rally is that effectively the Fed is coming to the end of its rate tightening cycle. The market, I think, is overly optimistic, though, John, as pertains to the prospect for cuts. I think cuts are out of the cards, certainly for this year, and most likely into the majority of next year, unless we see a more marked deceleration in consumption, and that would have to come along with a rise in the unemployment rate. So without either of those two things, unlikely that we get the expected Fed cuts that the markets are pricing in right now.
So against that backdrop, one of the things you've talked to your clients about is investing like a squirrel. Can you elaborate?
Yes. Yes, sir. Well, squirrels are the best risk managers. You know, they make a heavy stash for the coming winter, but when things are looking good, you know, they're flying from tree to tree and they're just trying to live their life. And that's, I think, what the markets are doing right now. So yes, stay long the markets. That's my point. Stay long in equities. Inflation is coming down. The Fed is effectively at or close to its terminal rate. So we don't have to get out of equities altogether. But yes, invest like a squirrel in the sense that protect yourself. So one of the recommendations I had earlier this week, John, was hedging yourself on the triple Qs. That, of course, is the technology space, which up to that point had risen 45% year to date. And as we all know, has been the main driver of the S&P's rally. So what I said is, look, hedge yourself. Buy those puts. They're exceedingly cheap. You can protect yourself with a 10% downside 3 months out at a very attractive dollar amount. And that has effectively paid off very handsomely year to date. We have, or week to date, we've seen tech pull back a little bit. And I continue to think that one should protect one's positions, especially in a counter-cyclical way when the market is so euphoric, so excited about the Fed's end and disinflation's trend, and build up those sectors that historically outperform in a down cycle. Those are the defensives, gold, cash, and the put hedges.
Okay, let's, before I let you go, talk a little bit more about how those option hedges might work. For those who are a little bit less familiar with those, what might be an example of a way to hedge your portfolio?
You can buy, the simplest way would be a naked put option. You can get one 3 months out for October expiration, 10% below current triple Q pricing. And you can pay, last time I looked, it was $3.10. So that's an attractive price to buy outright naked puts, such that once you get below 4%, between 4%, or you could do a put spread. But as soon as the triple Qs start to drop, you're profitable and you're entirely protected at 10% drop. So I think this is the way to go. And the worst case scenario, you lose the insurance that you've taken out. Best case scenario, you're entirely protected.
Okay.